All right, finished up a pretty bearish week in the S&P 500. Was it bearish enough to nullify what had been a burgeoning bullish trend and expectation for some bullishness heading into the end of the year? So I'm going to break that down. I'm going to break down the red flags. More red flags have developed from even Wednesday, and we had talked about some red flags on Wednesday's Market Outlook video as well. So more developing. Are they enough now to say, okay, let's be more bearish? I'm going to break that down from a technical perspective. We're going to take a look at what has been bullish, what has been bearish, the correlations with some of these different markets, especially in crude oil, as well as the 10-year yield, which is obviously in the news, and the dollar's breakout. So we'll break that down as well, and then our trade ideas in a stock that had been so bullish, shown some signs of weakness, rallied up, but not very strong on the subsequent rally that we might lead to some more of a bearish trend to the downside. Let's go ahead and get started. Today is Friday, September the 27th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's take a look at the S&P 500 here with the Market Forecast Indicator. As you can see, we have the intermediate posture here is bearish, the weekly bearish, with light pink shading showing up on the chart here. The intermediate line falling down below 80. It's still about as weak of a bearish posture as you can get. In fact, we're still above the moving average. In fact, we're still above the 23% Fibonacci retracement level of this intermediate rally that we had. So we're still holding support in multiple areas, even with this pullback that we had on Friday. The one thing that this pullback has done on Friday, as you can see, is it has, here, let's go to the trend strength indicators, is it has turned what was a weak bearish posture as of Thursday into pretty much a nothing burger here. Noise, that anything below 50 is noise. Now, if you look at the rest of this year, there's been a few other noisy periods, right? This was a noisy period because we were coming off of a bearish pattern, and it turned into a bullish trend. Then we had a noisy period here as we were kind of sideways, and we had a little bit of a bearish posture that rectified itself with a noisy period, and then a bullish trend, then a noisy period here, and then we had a little bit of a bearish intermediate pullback in a noisy period into a bullish trend. So now the question is this a noisy period into an intermediate pullback like we've seen in the past, when you see these intermediate runs end like they have. Now, if I were to go back and give you a little bit of context here on this chart, you can see, bullish trends, you can end, they end, and then you have a little bit of a noisy period on that pullback there, and you can see lots of examples of intermediate runs that end with just like we basically saw right now. This was obviously a much, much stronger trend, getting all the way up to 30 here, and that's pretty rare, considering this would be the weakest bullish trend that we've had, even weaker than the one we had earlier this year, and far weaker than the one that we had starting the year. But you can also see over here in May and April some of the weak intermediate pullbacks here produced this noisy period, but didn't produce a bearish trend, right? It didn't get the red line, red histogram. So we can get, this is back in 17, we can get the types of pullbacks that we're getting right now, where we pretty much stay above the cloud. Some of these others, we kind of flirted with the cloud. Whenever these got red, we got below the Ichimoku cloud up above. We're still above the cloud here. We're still above the blue line on the Ichimoku study here. So again, as bearish as we are, and that has typically preceded some more bearish intermediate rally or pullbacks. That might not necessarily be the case here. We might just get the intermediate line pulling down below 80 and then stopping there. If I were to go over here to the Russell 2000, it's giving us that actually pretty bullish pattern. A bullish pattern being light pink shading, yellow line. We typically look at that as kind of a buy the dip type of pattern here. Yes, the intermediate posture is still bearish. Weekly bearish, that's a light pink shading. and the short-term sentiment is relatively bearish considering how oversold it is, and that's the other factor too with the S&P. You can see the S&P, the near-term line turned right back down below 50 after only 1 day above it. So this isn't the most bearish sign, and the kind of the next worst case scenario is to close below this 29.50 and work our way down towards 29.25, and the closing below that would be really our next. You do have this kind of rising trend line, but more than likely you come down to this trend line here. That's going to mean that the intermediate posture has turned down below 50, which means that would be the extent of this bullish run, and it wasn't a higher intermediate high point. We've had higher intermediate highs, we've had higher intermediate lows. This would be our first non-higher intermediate high point. So a little bit of a red flag developing there. All right, before we look at some other charts, I always invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. Also, hit that thumbs up icon that's down below the video. That lets us know that you liked our video, that you want us to do it again on Monday. It's a quick way to give us feedback. It's our only way that we can get feedback from you since we don't send out surveys. So just let us know what you think with one click. You can do that right now while you're watching. Also, comment down there on anything that stood out to you in today's video. What did you get out of it? What did you learn? Let us know down at the bottom. What questions or comments do you have? Let us know down there. Join our Market Scholars website. You can subscribe to our Market Scholars website for free. There's a link popping out right there in the top right corner of your screen. You can click on that link to subscribe. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook community that we've created on Facebook. We also invite you to check out our Market Outlook Live. This is for our subscribers, both our Plus and our Premium subscribers. You can see the different subscription levels we have on our pricing page here. That was a very highly requested feature from a lot of Market Outlook viewers, is to be able to continue to watch these trades going forward and manage them all the way to their close. And that's what we do in this video every day that I do the Market Outlook. We review old trades, see how they're doing, manage them until we close them. And then we also put on today's trade idea before the market ever closes. So we do those at 3:30. I invite you to check those out. Also down here below the video, we invite you to engage with us on social media. You can do that really easily by just clicking this heart. It opens up a new window. You can like today's Market Outlook tweet there. Click on this image. It takes you to your Facebook page. You can like today's Market Outlook Facebook post as well. All right, back to the charts. Let's take a look at the long-term chart. And another red flag that we have developing here for this intermediate posture is this transitory, this kind of transition candle here. Again, we typically see 4 to 13 weeks. This would be the 4th week, and that's it. So this might be all we get out of this current intermediate rally. And again, not a higher high. So that's a little bit of a red flag there. Again, you expect bearish candles to come out of that. This is what it looks like on a regular candle trend. So we'll see if this 50-day moving average support holds and we bounce off of this and continue higher, or if that transition candle turns into more bearishness, especially with this momentum, the PPO down here rolling over itself and maybe potentially closing the gap between this 50 and 200-day moving averages. Now let's take a look at the 3 green arrow chart. You can see we do have, let's just go to SPX here, and let's just save that so I don't have to retype that in every time. So you can see we do have 2 red arrows. We don't have the 3rd one. We do on the Russell. The Russell 2000 is giving us 3 red arrows. And like I said, on the bullish trend, that can be a bullish pattern because you can bounce right off of those 3 red arrow charts. So we'll see if that ends up being the case here. We're close to that. You can see the MACD and stochastics, what they're doing down at the bottom. You can see that the MACD is close to 0, but not quite. Stochastics a little bit below 50, but not into the oversold zones. The 8 and 17 day are falling, but not below 30. Again, so we've seen this before. We saw it over here. We saw it over here, and we'll see if that turns into both these areas gave us weak bearish postures. The MACD itself never fell through. And definitely the orange line never crossed below, and that's even more significant. And you can see over here the orange line dipped its toe a little bit below 50. The orange line's easily still above 50 up here. they're smooth moving averages of the MACD and stochastics that we typically check out. So, we could be a lot more bearish, but they definitely are, again, red flags, but not strong enough red flags yet that would change the trend from bearish to being bullish. Let's take a look. All right, let's take a look at the intraday chart here. Here we go. So there's the drop. In fact, we finished filling in this gap from back here on Thursday when it broke through. Little bump in volume there, so not as pretty of a breakaway gap because of the lack of extra volume. But we ended up, and it took a while, but we ended up filling in that gap. There's a little bit more support down in this area, but very little. It's got a lot more headwind, and you can see kind of why we're struggling to get above this 298 level on any kind of rallies, and now breaking through like the low point that we had last Tuesday, acting as a resistance. In fact, yesterday's low point acting as resistance as we went through it, and then bouncing back up by the end of the day. We're also flirting with the low, not just the lower half of the chart, easily below the low of the Heikin-Ashi candle or the open of the Heikin-Ashi candle. We're also pretty much flirting with the low end of the value area, which, again, path of least resistance is to the downside right now. So big red flag there that we need to watch for. So get back into this value area Monday towards 298, if not through it, then okay, we're feeling a lot better. But if we kind of hit this resistance and we spend more time towards 294 on Monday, then there's a good chance we fill in towards 290, 292 and a half by the time all is said and done, at least, as there is some, you can see there's some support in that area on the Bollinger Bands here. Support at the 292 area where this volume node is right here, just below the top of the value area. And then, of course, you have major support here at about 288. That's where the point of control is, and your final layer of support at 280. So, there's some, it's not going to fall off a cliff here, as there's lots of support levels in between here and, 280. And then finally, if it gets below 280, now you got a little bit of a support here at about 273 and 3/4. After that, it's to the downside after that. Let's take a look at today's volume and trading range here. So let's pull that up here. Give me 1 second. Pull up SPY. And you can see the trading range was above average, 4.25 points versus 3 above average, and the volume at 84 million. So let's go take a look at those numbers in context here. And it would be right here. And you can see 4.25 points is right here. So it's pretty bearish. It's not extreme, but it's big enough to bring the average up. 84 million is relatively bearish. It's, again, not extreme, but big enough to bring the averages up. It's, if you continue to get these kind of above average numbers that aren't extreme, right? Extremes, it sets the low point like we've seen before, even if in this case, like including the gaps, these big extreme levels, they set the low points, right? But the kind of more consistent, gradual negatives, they can be, they can start bringing these lines up, and these lines go up as we pull back, and they fall down as we bounce. So we'll see how, if we on Monday and Tuesday, if we continue to get these kind of big size moves up or down, that's not a really good thing for the market. We want to see it continue to get back below 67 million shares traded, to get below 3 points, stay below 1%, get the ATR back below 1%. That's where, we're back to being bullish here. And then finally, you look at the volatility index. Volatility index peaked up to 18. Again, we're not up to 20. We're not above 95% here. So, volatility has ramped up, and again, red flag, but not trend changing, right? Getting above 95, that's different. Now we're more bearish. The fact that we're still held that and we're rolling back over here is a good sign that, again, we're averting the worst case scenario here and just flirting with that inflection point. Getting up to the line but not crossing the line from what is this newly bullish trend that has expectations for a few months to come out of this, versus like now the bullish trend's over, intermediate run's over, and we're headed towards more declines in the market. All right, before we check out what's the different intermarket relationships, what's driving the markets, and our trade idea of the day, just to summarize the technical outlook, the markets are still bullish. There's a weak bearishness to it. The weak bullish posture that we had, this new bullish posture is kind of flirting with ending, and multiple red flags popping up, more than what we even saw in Wednesday's market outlook video, but not to the point yet where we've really changed the posture, and to the point of no return, back to the bullish posture. We're getting closer, but there's still opportunity for us to reverse things back, say early next week, to the upside. And again, that would be the expectation until some of these support levels are broken. Again, you always expect support to hold until it doesn't. So with that being said, what do you think about that? Do you agree with that assessment, that summary? Do you disagree? As always, you can vote by clicking this link right here. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below on what you're seeing, or whether it's a chart or an indicator or whatever. What chart are you seeing that would suggest otherwise from what we just came up with our technical routine today? All right, now let's talk about what's driving this price action. You can see a big cause for the weakness this week showing up in the crude oil market, and that's generally been the case. Crude oil's really struggled here, finishing down 4.5% for the week, and it's hard for stocks to really get a good grip and a good grip, to the upside, a good move to the upside, without crude oil making that move as well. And you can see even gold, like the dollar was up today. This week, that pressured gold. So it's not like a complete risk off move. Long-term bonds and foreign bonds are relatively bullish. High yield, you can see down, but outperforming equities. In emerging markets being the equity class that did the absolute worst. If you take a look at, let's take a look at crude oil and how it did here this week. First on the long-term chart. And you can see, after a relatively bullish breakout week last week, completely reversing that with the transition candle this week. So that trend didn't last very long at all. This is what the candle looks like here. And of course, last week we started off so strong and came down throughout the week, continuing those declines. This week back below the 200-day moving average, flirting with getting back below the 50-day moving average, and still some negative momentum. Not as negative as it was over here during that decline, but still some negative momentum here. Looking at the Ichimoku cloud for crude, you can see, we're still above the cloud, barely. The green line's still above the blue line. The red line's flirting with getting below the price at its level, and you can see the bullish trend that we had has now turned into noise. Crude oil's been noisy for a long time. It's been kind of trading in the sideways range. One little news-driven breakout that's been completely reversed. So still in this range, not really breaking out one way or the other. So until we do, it's just simply going to be noise for this. And that's going to have an impact, a correlation with equities. Risk on appetite. You can see the 10-year note made a pretty decent bullish run up towards that 23% Fibonacci retracement of its latest declines, right, that we've had up here since the peak we had in October all the way to now. It's a nice little rally to get to that 23% retracement level, but then stopped, right? It stopped, and now we're kind of flirting, staying below the cloud. The red line is above price, so it's still relatively bullish from that perspective. But the little bullish, whatever weak bullish trend that we had is now over, as we're back to a noisy period here. We're not bearish, but you can see how quickly things kind of changed here. Let's go to USO on the Bollinger Bands. We did get to this volume node right around 13 and peaked there and has come back down into this volume area. This is where the sideways trend's at, and until you break out of this one way or the other, and there's not a whole lot of downside. I mean, of course, you can go down to anything, but it's not as much downside potential, considering how low it is already, and all the support that's in this area, as much as there is upside potential. So there might, if we do kind of get any kind of breakdowns at all in crude oil, expect it to come down towards 10, maybe 11, and stop any declines at that area before we find some support and work our way back to the upside. And this is what the futures contract looks like. A very similar pattern. Again, 52, 53, 52 and a half, down to the low end of this Fibonacci retracement zone is where support on any pullbacks would be. Let's take a look at the dollar index. That's been a key factor here lately, and you can see holding up this little breakout move we had since Tuesday's low point all the way up. Again, good sign for the dollar, for this trend that we're expecting in the dollar to start working its way through. This is what UUP looks like, getting above the upper Bollinger Band, breaking out, above this volume node that we had. Very little volume to the upside. You take a look at, over here, linear regression for the dollar, DXY. You can see we're, flirting with the top end of this first channel. It's pretty darn bullish there. Might run out of gas in the short term, but pretty bullish from that perspective. And you can see from the 5-year, lots of room to work, to trend to the upside before you kind of get a long-term overbought condition that we saw in other asset classes like gold and TLT, which we expect. I actually expect TLT will stay up here while there's still rate cut odds, which are pretty high for by the end of the year. About a 70% odds we'll get a rate cut by the end of the year. So if not October meeting, then December. That's going to impact TLT. Yields will stay down until we get rid of all those rate cut odds. Then you'll see yields take off. Then you'll see TLT really come down at that point. That doesn't impact the dollar. What impacts the dollar is all these other geopolitical trade war and yield spreads between U.S. yields and other developed market 10-year yields, which remain very, very large and give the opportunity for the dollar to maintain this bullish move towards 100 and beyond 100. If you take a look at the different countries and how they're doing, you can see some are doing better than the others. I mean, you got light pink shading across a lot of these. Green lines, though, green lines in the United States, but yellow line in China, which means we're below a rising moving average. Green lines in Germany, France, Italy. Dark green shading in Japan, India, the UK, even though that's not going to last very long in the UK. Brazil and Canada. So some of these areas are showing some relative strength. Green lines, dark green shadings on all of these, including Japan, even with some pullback. See the pullback in China, Japan, a little bit of India, as well as especially Korea. Some of these are only, the Korea is getting close to the moving average. China's gone through the moving average. Canada's so easily up above it, and as well as Japan. So you can see where the strength is in some of these Asian areas. You can also see where some of the weakness is, relative weaknesses in some of these other, and you can see Russia kind of included. Very similar looking chart to what we see with South Korea there. All right, from a sector rotation standpoint, you can see, again, this is a 3-month chart. Over the past 3 months, you still have strong performances in these safe haven asset classes, and they did this week. There's a strong week for them, still weak. These losers that rallied up so much during this bounce have been pulling back the most during this decline, giving back some of their more recent gains. Some of the, again, oversold conditions. Again, you don't want those areas. You don't want the biggest losers to lead us to the upside. You want the cyclical areas, to lead us to the upside, and that wasn't the case this week. If I take a look at their 12 grid, you can see here that a lot of light pink shading, and the only dark green shadings are with the 3 safe havens, and healthcare is our one dark pink shading, where we have a strong bearish posture below 50 and a red line. The rest of these, green lines here or yellow lines on technology, discretionary, communication services. Again, those are the things we want to lead, and right now they're leading to some weakness. Now again, these are 3 red arrow signals, type signals, so we'll see if we bounce off of those or not. Some of these other, again, these are the kind of the biggest losers, not so much materials, but financials, industrials, energy, healthcare, and you can see the declines they've had here this week, especially after giving up some of those big bounce, so the gains. I mean, industrials jumped up so much it had a cluster here during its rally. So giving back some of those gains, you would like to see them pass the baton up here to the top, to these cyclical groups. We'll see if this little break, light pink shading yellow line, which is typically a pretty bullish pattern, turns into a bullish move in those areas. Of course, a bullish move in those areas would be bearish for a lot of these staples. And so for our trade idea of the day, I wanted to take a look at one of those staple companies that had bounced up and might be running out of gas itself, and that is Hershey's. Hershey's, you can see the intermediate line got up to above 50 and it's not quite getting above the moving average, so we're back to dark pink shading red line. If you look at some of these other, like its Bollinger Bands, you can see that it's, there's a point of control here, or a volume node here in this area that it's come back up to and hit as a resistance level. And look at the volume gap we have until you get to 138. So holding this level of volume would, there's not very much volume above us, but there's not very much below us either. And again, that's we kind of set the bearish move here and bounced up, did not get bounced up to a higher high, to a lower high point. We'll see if that rolls us down to what would be a lower low point at that level. You look at some of the other indicators here for Hershey's, and you can see the green line is below the blue. We're flirting with the cloud, with breaking below the cloud. We have the weakest of weak bearish or bullish postures here, much less bullish than what we saw on these other previous intermediate runs. And we'll see if that, and if you look at the MACD histogram as well, let's pull up the MACD histogram. Nope, sorry. Here, MACD histogram. You can see how the MACD histogram pulled up towards 0. These lines are converging, and the expectation is we'll diverge now to the downside here from a long-term perspective. Here we go. From a long-term perspective, you can see the the bearish candles that we've been getting. A little bit of a transition candle, but again, as bullish as momentum is, again, 138 is where that layer of volume support is. I would venture to guess by then that 200-day moving average will get into that area, and we can fill in that when this gap is so big and we're losing, we can tend to fill in that gap pretty quickly, at least to the 200-day moving average, and then set a low point and bounce off of that. So for our trade idea of the day, here, let's get rid of that one, and come down. You can see we are looking at not in October, we're looking at November, and say, okay, well, I can buy this at the money put my stop order at 50% of that put. So it would be like this: buy custom with stop, and put my stop order at 50%, which would be around 285-ish. Make that a GTC, and say, okay, if we continue to go down to that 238 area, and you can see what it looks like here. Let's just look at a single symbol. Let's go to regular chart here, and we'll get rid of the long call vertical we did on a previous in a class trade from a previous class that we already have been bearish on. But if we break down to the downside here towards 138, you can see you get about a 2,000 plus reward for potentially worst case scenario $1,000 of risk, but best case scenario the the scenario that we'll get out at is half of that. So that puts us, with our 50% stop order, that puts us about a $560 risk, 565. So about a 3.5 to 1 reward to risk ratio if it fills in that big volume gap on its chart. All right, and as always, that does it for today. You've heard from me now. I want to hear from you. Use this link right here. It takes you to our Market Outlook forums at marketscholars.com. Free subscribers are able to participate in that forum. The forums are for our premium clients, for our classes, but for the Market Outlook forums, they're for any subscribers, including our free subscribers. Open up any new threads with any questions or comments you have about the Market Outlook. Let me know what you're thinking, and make sure you also reply to anybody else's questions or comments. And let's keep this conversation going over the weekend here. As always, hit that or subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below, follow me on Twitter for more content in between the videos, and like I said, join our community that we've created on Facebook as well for our Market Outlook viewers. As always, thank you very, very much for coming on our watching our video here this weekend. Have a great rest of your weekend, everybody. We'll see you all on Monday.